Hello, everybody. Welcome to Clever Investments. Today, let's finish discussing the covered call strategy. So, one thing that many researchers and professional traders already know is that the stock movement is not a normal distribution. It is a fat tail distribution. And you can see in the picture on the right, the normal distribution's probability shows the blue line, but the fat tail shows as the orange line, where it has a much bigger tail, which means the price can move to the extreme left or extreme right at a much higher probability than normal distribution. So this means sometimes stock can go down or go up by a lot more than what we calculated. But with covered call, it will cut the gains of the extreme up moves and take all the risks of the extreme down moves. When they combine together, the covered call would easily lag behind buy and hold. And this is a mathematical intuition behind a key reason why covered call is not good. So you may wonder that maybe I can treat covered call differently. So for example, I could sell at the money call to get the maximum premium, or I could partially cover my stocks. So for example, if I have 1,000 stock shares, I need to sell 10 calls to cover all the 1,000 shares. I could sell less calls so that it's partially covered. This allows the stock goes up without upper bound. Of course, you get less premium because you sell less calls. And you can also actively manage it. Basically, you time the market. So if you think the market will go up a lot next month, you can pick a very high call strike, or you don't sell call at all, just for that month. Or if you think the market will go down a lot, then you pick a very low call strike so that you get a lot more premium and you don't need to be worried about the market going up. Or you can combine all the above, actively manage it. Maybe you think the stock will go up a lot, you can sell less calls with higher strikes. Or if you think the market will go down, you sell more calls with lower strike. So I did a search and find that there are many kind of covered call strategy ETFs where you can buy and get into the covered call strategy. And many of them are different. So for example, PBP has a longer history. It sells around 2% out of the money call, and it is 100% covered. It's a passive strategy so that it uses strict rules. There's no human judgment in it. Or the XYLD sell at the money call, which means it sells very expensive calls, get huge premium. But of course, it's very hard to get much upside if stock goes up. It's also 100% covered. And there are some other variations where some use active management and they partially cover the stock. So we can compare their performance and see how well they have done in the past. PBP has the longest history, so let's compare PBP first. So if you go to Yahoo Finance and you put PBP in it, you find this ETF. And here you can notice that its yield is 10%, very high. So this means when we compare the stock price, we have to include the dividend, and we can assume dividend reinvest. Otherwise, it would not be a fair comparison. So let's first go to the historical data, and let me pick monthly and max. Okay, so looks like it started from 2007, and you can notice there are two prices. There's close price, there's adjusted close. Adjusted close give you the price that's assume there's no dividend. So basically considered dividend reinvest. So if you scroll down, you can find the adjusted close price becomes lower and lower, although the actual close price is high. So you go to the beginning, looks like at 2007, the price is around $9 if you adjust for the dividend. And now it's $22, so it's more than doubled. If you go to the stock chart of Yahoo Finance and you pick monthly and all, so it starts from around 2007, you can see the price didn't double. The price is around 24, 25, around this range. It didn't go to 9. So this means the Yahoo Finance chart doesn't use adjusted close, but we have to use adjusted close to consider the dividend so Yahoo Finance cannot be used. And also, similarly, Google Finance website also cannot be used. I found that Thinkorswim helps. So in Thinkorswim, you need to go to the charts and click settings. So go to the price axis, click show price and percentage, and also go to time axis. It's very convenient to expand to the right. I input 5 so that there's 5 bars to the right after the last price. And then if you go to equities, it shows adjust for dividends, only special. So this is the default, but we really want to adjust for all. So if you notice the picture here, I already added some covered call ETFs there. And if I adjust for all, and when I click apply, you can see those prices are gonna go up because the adjusted price will look lower. So let me click apply. See, it goes up. Okay, so now we have adjusted. Then you need to compare all the ETFs you want to compare. And the way to do it is you go to studies and study, and then compare with. You put in the custom symbol. I already put in all those symbols I just talked about in these slides, PPP and also SPY, which is S&P 500 index. Okay, so let's compare them. So this line is SPY. How do you know it's SPY? You move the line to the right, and you can look at the top of the screen. It said comparison line SPY. Okay, so PPP has a longer history, and if you compare PPP, including dividend, with S&P 500, it shows a huge difference. And if you look at the 2020 crash due to COVID, after the crash, S&P 500 recovered very quickly, but for PPP, it took a very long time to recover, which is what usually happens for covered call when there's a very large up in a month. Okay, so now let's compare other ETFs. All those ETFs, they have a very short history. So no matter what result we get, it may not be very representative. And we have this yellow-orange line, what it is. Now you look at the picture on the top, it is JEPI. Okay, so this line is JEPI. If we go to the slide, we know JEPI is actively managed. So some professional money manager look at the market, try to time the market, try to not cover it by too much. But look at the performance, it's not great. So this is since 2020 and about 5 years ago. So let's look at 5 years history. Time frame 5 years. Okay, so in 5 years, this blue line actually is SPYI. So SPYI is also active managed, but SPYI started at this point. So it's not an apple-to-apple comparison. It started too late. So we need to discard this line. And in this case, the winner is still SPY. So if we only compare the last 2 years, like from here, because the latest ETF is since the last 2 years. But 2 years is definitely a too short time to make meaningful judgment. So 2 years. Okay, now is SPY still the best? SPY is the purple line. SPYA is the blue line. So SPY is still number 1, but in 2 years, anything can happen. So I wouldn't treat it seriously given this short history. It's better to compare the longer history, let's say last 15 years. And then you can see SPY is so much better than anything else. Okay, so if you want to do covered call and actively manage it, it depends on how well you can time the market. And for me, I don't know how to time the market, so I don't recommend the covered call strategy. Okay, finally, a disclaimer for this video and all other videos in this channel. I was just sharing my personal views here, not investment advice. Investing involves risk, so please do your own research and make your own decisions. Thank you for watching and see you next time.